Sorry, my last recording cut off, so what I'm talking about right now, I didn't have a chance to see where I left off, but I talked about Vegas real estate, just in case, so I will repeat a bit here. So what happened is, I went to Vegas in 2010, and real estate was still depressed. I saw this great house. It was $270,000, and it was a quarter of a mile from the Strip. It had a swimming pool, had a view of the Strip. It had a sunken living room with a fireplace. And it was still depressed over a year after the bottom in the markets, and stayed depressed until 2012, and then finally real estate started coming back in 2012 till the present. And I'm talking about how a friend of mine who lives in LA, what he's looking for now is at the bottom of the recession to buy real estate and flip it. So what I'm getting into is no one wants to buy gold. Gold is breaking out. Yeah, can gold consolidate here? Go down $100? Yeah, sure, why not, right? $14.50? You know, do a $14.30? Sure, why not, right? So, I think gold can do really well afterwards, and if there consolidation, but we're in a massive breakout. A lot of people have talked about, maybe it's like 2003 when it broke out. It was a false breakout, went back down into May. I don't really think that's going to happen here, because I look at the backdrop, first of all, monetary policy. Even if the market goes up, it's going to be because of pump job, printing of money, rates going back down, etc. And if the market keeps tanking and there's still this fear trade over trade, fear trade over trade, you're going to see gold continue to go lower, right? So, go higher over that. So I just find it amazing, and it really was coiled spring. You have the 6-year base. I've talked about this little saying: the longer the base, the more the space, and you've broken out of that, and I think that's why you've seen such an explosive move to the upside, where 1400 was kind of this, resistance range that held for 6 years, and then boom, when it went, we've gone right over 1500. And I think 16 to 1700 is the real key area. What I mean by that, I'm active in the junior mining industry. I buy private placements, and I already see things starting to heat up, and I think that at 16 to 1700, that's when these juniors, like the higher cost mines, really start kicking in to positive cash flow then. Like stuff like New Gold, stuff that's really struggled. Even then, when you get that, there'll be leverage. And then a lot of these properties that say have 43101 resources and a lot of gold in them, they become much more economic as well, at those kind of gold prices. So I think I'm going to turn around soon. So I think that gold is going to look good at those levels, and then we'll just see what happens after that. But I think that really, just to be patient about it, really by the end of the year, you'll see that 1600. So if you do see a bit of a consolidation here, it will head higher. So, you're going to want to position yourself for that. But I just find it interesting that, my subscribers, some of them are long-term gold bugs. They always, because of my background, they're always interested in the private placements or in precious metals. And, they're interested. But I think the average person, if you go look at, you can track these things like that Robinhood, which is a trading software, or what people are doing on TD Ameritrade. Like virtually no one's into the gold stocks. There's still... I think what happens too is a lot of the retail investors and speculators in Canada, where I'm from, the marijuana stocks are the big thing, and they've come off seasonally. They tend to do well. So if you do own them, barring some kind of big meltdown in financial markets this fall, they should start this kind of seasonal trade higher, probably within the next few weeks, actually. But and I think like what happened though is a lot of those traders, I still have a couple marijuana deals that are about to trade. I think a lot of those people were just struck, blindsided almost, by how quickly it changed, right? And how it changed was, we saw gold go from, this breakout in just 2 or 3 months, and in the last 3 months or so, like CGC is down 50%, Prawn is down about 50%. So that's kind of normal for them in some of the corrections, but I just think a lot of those people who really just thought those stocks were going to go up forever and gold and precious metals would do nothing are caught blindsided. I think that's important, by the way, because those retail investors who speculate in crypto, speculate in marijuana stocks, they're the kind of people that are getting the precious metal stocks. So anyhow, and the last thing I'm going to talk about as I'm making my way back here on the beach is the secular bull market in bonds. Okay, so what's really interesting is a lot of these big bull markets are kind of representative of a decade. 1920s in stock, 1970s in inflation and commodities, 1980s in Japan, 1990s in tech, and they end in the year 9. So, the Japanese was a class one. It topped on the last day, trading day of 1989. So that was it. So, when the decade ended, so did the bull market. In terms of gold, it went up into January of 80. In terms of tech stocks, they went up into March of 2000. And it was September in 1929 when stocks topped. So I think we look at this and you can see the sun just going to sit over the hill there. But anyhow, I think that's going on in bonds right now. Now, will bonds peak in September? Like, August, September? Like stocks in 29? Who knows? But usually these things tend to go the rest of the year. Especially in the fourth quarter, I think, if bonds are holding up, people will be chasing them because they'll be one of the best performing sectors of the year. So you're going to see that, right? And I think you're definitely going to see these things blow off. And I think a lot of people think, oh, we're going to be at zero rates forever. I really don't think that. I think Japan is a very unique circumstance where they had their bust before the rest of the world, and they had their bust when the rest of the world was still booming in the 90s and 2000s and even 2010s. And what happened was, because they're such a big export-orientated economy, they're able to use their trade surplus, their current account surplus, basically making stuff. Japanese car manufacturers are still some of the biggest companies in the world, and using that to support the economy, keep it down. And then of course domestically they have very little immigration, so this kind of very stable populace. So there's no real civil uprisings. There's all kinds of things, and the bond market's all domestically owned. I don't think that if the next downturn, when you got UK, Spain, Italy, the US, Canada, Belgium, France, all of these countries, debts are going to explode over 100% of GDP. You're just going to see these bond yields sit there. I think at first, if we get the first leg down kind of the economy this fall, you'll see this kind of escape. But I think this next leg, and this kind of is what happened in the peak countries from 2010 to 2012, when the next leg happens and the debts really blow up and the deficits blow up, I think you'll see the yields back up because investors are going to want more in a time of this exploding government debt. And it doesn't have to see the 10-year yield go to 10%. It's like the way the debt's structured right now, if it went to 4 or 5%, that would cause a major problem for the government. So that's my last theme here, that we may be nearing the end of this kind of secular bull market. And remember, this started in 1981. We're almost 38 years into it. Bond cycles tend to be long, 30, 35 years, but even by a bond cycle, this is abnormally long. So anyway, I'm going to leave it at that. So our themes today were the catch-23 that Trump is in, with China, the stock market. He doesn't want a bull market in stocks, or does he really want to take on China? Then the gold breakout and how no one really is believing in it, which is probably better for it in the intermediate to longer term. And then finally, the secular nature of bonds and how this could be a massive blow off in the bond market right now. So I'm going to leave it at that, and everybody take care. And I'm going to walk the rest of the beach and go home.